industry and housing ecosystem, and he's recognized for his insightful analysis and commentary on the U.S. economy and real estate market. Mohtashami is a lead analyst for HousingWire, the most influential source of news and information for the U.S. mortgage and housing markets, and is a regular contributor on the HousingWire Daily podcast. How many people listen to the podcast? Awesome. If you're not listening to the HousingWire podcast and to Logan's input on the podcast, I 1,000% highly recommend that you do if you want to be informed and understand what is happening in the market with economics, why interest rates are where they're at, all of the things, okay? He has a background spanning over 2 decades in the mortgage industry. He's nicknamed the chart guy. He is on the nerd tour right now. He has a remarkable ability to decipher complex economic data and translate it into understandable, actionable insights, and this knowledge has made him a sought-after commentator, and his expertise has been featured extensively in news outlets including CNBC, where he is a frequent guest. He has a passion for data and economics coupled with his years of direct lending experience, which provides industry professionals with critical insights into the ever-evolving mortgage and housing landscape. And he is a gigantic 49ers fan and
anti-central bank.
And anti-central banking. Okay. All right, let's welcome Logan Mohtashami, please.
Let me turn this on. Can everyone hear me? Okay. I don't think anybody here was alive when the Detroit Lions won a championship game. So let's all feel a little bit of pity if they lose, because it might be another 50 years. My name is Logan Mohtashami, lead analyst for HousingWire. Just a little bit of a background. Our family's been in banking since the late 1950s. My father opened up his own mortgage company in 1987. I became a loan officer in the early part of the century. I retired early 2020. I started writing about housing economics in 2010. One thing led to another, and now I'm on a nerd tour. So my job today is to basically try to take the madness of the housing market and try to make sense of it so all of you can talk to your clients, your friends, and everyone has an Uncle Dave that in Thanksgiving tells you it's Housing 2008. So everything I'm going to show you today, you'll have access to, and it'll be easier for you to actually explain to your clients. How many people here have been married for over 20 years? Okay. This is a chart of the 10-year yield and 30-year mortgage rates. I always say that this is the love couple slow dance that have been together since 1971. You're going to hear a lot of rumors and falsified things that drive mortgage rates, but what drives the 10-year yield drives mortgage rates. Now, sometimes the spreads can be very bad. Look in the early 1980s, the slow dance was drifting apart. We have pretty bad spreads right now, but what pushes the 10-year yield will push mortgage rates up or down. And I think what happened last year is a lot of people thought because the growth rate of inflation was falling, mortgage rates would get back down to where we are accustomed to. That's not technically correct. Global bond markets are much higher. The growth rate of inflation is much higher than what we had in the previous decade. So what I'm going to do is try to explain where I think mortgage rates are going to go and what will drive it. Every year, I give a forecast on 10-year yield ranges and where I think mortgage rates should be. Last year, 10-year yield between 3.21 to 4.25. That means mortgage rates between 5.75 and 7.25. Early in the year, the 10-year yield was breaking to a level I did not think it could pass because I believe the labor market really drives mortgage rates at this point. So I had to create a character that all of you could relate to. Every time we were about to break that level, I thought, Gandalf the Grey, you shall not pass. So for all my social media, I kept on doing Gandalf videos. We're not going to break this level. We're not going to break this level. We're probably going to hold here. And a lot of people thought we were going into a recession. The banking crisis happened. The bond market thought the Fed was going to pivot. The Fed was not going to pivot. The Fed is hell-bent on destroying a ghost 1970s inflation. So when the banking crisis ended, the 10-year yield rose up. That top-end red line chart there, that was kind of my peak for last year. So why did that level break? Well, you could, Taylor Swift, Barbie, third quarter GDP was 5%. Everybody was spending money. The Fed got very hawkish and the bond market kept on going up. So hopefully, some of you that listen to the podcast know I consistently bash the Fed because I know their staffers listen. We don't need to fight the 1970s inflation so they could let it go. So I do believe that over time, the 10-year yield should be going lower. I'm very happy to hear that the Fed was a little bit concerned that the 10-year yield got up to 5% and we had 8% mortgages. Housing doesn't work with 8% mortgages, not with home prices where they're at. So going out for the rest of the year, the 10-year yield should go down. The growth rate of inflation falling is actually a really big deal because the labor market still hasn't broken, and if the Fed didn't sound less hawkish, we'd be talking about 7.5%, 8% mortgage rates today, but we're not. The other unfortunate aspect about housing last year, this is the spreads. This is between that 10-year yield and 30-year mortgage rates. I'll talk about that slow dance. If you look in the past decade, the spreads were very low. That means that there was a better relationship between the 10-year yield and mortgage rates. During every recession, mostly, the spreads go wider, mortgage rates go higher, and then during COVID, the Fed came in, did everything they could to keep the economy moving, but once they got out of the marketplace, as you can see, the spreads got wider. This is why mortgage rates are higher than they should be. Today, as we speak, mortgage rates should be under 6%. It isn't. In a normal marketplace, the spreads would be between 1.6 to 1.8. That means where we are right now is about a little bit above 1% higher. So this can get better this year. Now, last year, we had something good. The spreads were getting better, and then the banking crisis happened. Silicon Valley Bank crisis happened, the markets got stressed, and not only did the spreads get worse, they hit a new cycle high. So unfortunately, that gave us 7.5%, 8% mortgage rates. One of the Fed presidents last year, in February, when mortgage rates got to 6%, came on TV and said, oh no, 6% mortgage rates. People are going to be buying homes again. They're going to make our lives difficult. So I'm hoping the Fed changes the tune a little bit more now because the growth rate of inflation is down. We'll have some inflation charts to show that later. Now this, to me, is the most important economic data line in America. This is jobless claims. These are people that file for unemployment benefits after they get laid off. Jobless claims are historically very low today. If this data line was getting near 300,000, we'd have below 6% mortgage rates today. The bond market, that 10-year yield, that slow dance I tell you about, is looking at this data line, comes out every Thursday. I feel like a lot of LOs have gotten bad information from social media people on the labor market. They'll say multiple jobs or anything. No, the labor market, job openings are high, jobless claims are no, it's not breaking. So this, to me, is the biggest reason why mortgage rates are near 7%. The labor market isn't breaking, and the Fed hasn't pivoted yet.
Logan?
Yes?
Quick question for you. Do you by chance follow Thoughtful Money with Adam Haggard?
I actually don't follow anyone. Yeah.
Okay, so Thoughtful Money, that podcast is the most comprehensive podcast on macroeconomy that I've ever listened to. You know, they're interviewing people like Stephanie Pompoy, Lacey Hunt.
Stephanie Pompoy, I would consider not a legitimate person.
Oh, I would.
She is part of the anti-central bank crew that has been consistently bearish on everything.
But recession is usually forecasted for at least 2 years before we hit it. There's also Lacey Hunt, which is, you know, he was the primary economist for the New York City Fed.
I've known Lacey for a long time, yes.
Okay. So all these people talk about the revisions within the job claims and the multiple jobs that people are holding that profit up. So I'm just curious why you would say, I mean, there's so many people saying this.
I would take the multiple jobs. People take a piece of paper, throw it in the trash. I've heard it for 12 years. Multiple jobs is less than 5% of the workforce. Here's a good question. Does anybody know who holds the highest multiple jobs in America for 20 years? Who would you think is the highest percentage multiple job person? Graduate degrees. People that make over $200,000. Why? 1099s, speaking gigs. A lot of times they say multiple jobs are struggling Americans. The amount of Americans that work multiple jobs full-time, 0.5%. That's it. Lacey won't say it, Stephanie won't say it, Danielle DeMar Booth won't say it. They have all been generally bearish all the time. So we have economic cycles, and they all revolve around this data line. So my recession flag is 323,000. 4-week moving average. When this data line gets there, the labor market is broken. That's how it's been. I always make this joke. That's how it's been since the Peloponnesian War. Every economic cycle going back to World War II has had this data line break, and a certain percentage. We aren't there yet. And Stephanie was a recession person last year. It's going to be a recession person this year. She's going to be a recession person next year. There's a group of people that are just, they don't like the Federal Reserve, and they're consistently bearish. As you can see, they're like the Detroit Lions for me right now.
Easy.
So this is job openings data. Now this is a brand new data line for a lot of people. When I started to write for HousingWire in 2019, COVID happened, of course, in 2020. All my economic work going back 12, 13 years was like years 2020 to 2024 is going to be different for housing. Why? It's very simple. We rent, we date, we get married. 3.5 years after marriage, we have kids. People buy homes. Who's the biggest housing demographic patch in America? Millennials, ages 28 to 35 are the biggest. They buy homes a little bit later. We're going to get just a little bit kick in demand there. It should be better. Before COVID happened, does everybody know housing actually broke out? Housing authentically broke out before COVID-19 hit us. We had pre-cycle highs in demand. If it wasn't for COVID, actually, we would have had more home sales in 2020 than we did. But this is the job openings data. This is one of the things when I wrote my COVID-19 recovery model on April 7th, 2020. HousingWire at first wasn't going to publish that because I was talking about a recovery in 2020. One of the things I said, this job openings data is going to get over 10 million. How do we get job openings over 10 million when people say there's millions of people not working? Well, it's not true. The civilian labor force has a consistent growth. The baby boomers are leaving the workforce. They got to be replaced. It's not odd that this got to 10 million. I would say the 12 million number was a little fluff, and now the labor market is back to normal because this key data line is what the Fed tracks. This is the quits ratios. When people are quitting, they're quitting typically for higher paying jobs. The Federal Reserve has always told us this is what they don't want to exceed over 3%. We are pre-COVID levels. There's no need for the Fed to even be, they should be cutting rates 75 basis points at the end of January. So this data line will tell you that the labor market is no longer tight. Even though the job openings are historically high, it looks perfectly normal to our workforce. But the quits ratio, supply is back to normal. The Federal Reserve did not need to raise rates as fast as they did, right? The Fed told us that pain in the labor market, we have to break down inflation by creating a job loss recession. They forecasted 4.6% unemployment rate. The labor market is fine. The stocks got back to all-time highs, and the growth rate of inflation fell. So hopefully all these things together throughout the year will get the Fed to be a little bit more conducive. Now this is the total employment data. As you can see, COVID really messed up a lot of things. If we did not have COVID-19, basically this data line would be at 157 to 159 million. Today, we are currently at a little bit under 158 million. So to me, the labor market looks remarkably normal now. I think a lot of people were surprised that we had these really big job numbers, but if you actually look at it, COVID-19 was an exogenous shock, and we're just back to normal. So the labor market is not tight. The Fed is overhiked. They need to get off of that. Just keep this expansion going. And our favorite word, inflation. This is the consumer price index since 2007. This is just the growth rate of inflation. Inflation is always rising. We don't have a deflationary economy. The history of global pandemics have always been very inflationary, and then the disinflation happens. This also happens in war, right? Supply chains don't work. We're already seeing the fighting that's going on in the Red Sea. The ships are being diverted. The costs are going up. Except there's one thing that the Fed got wrong. The growth rate of inflation fell without a job loss recession. Job openings are high, jobless claims are low, stocks are backed. This is the battle between a few of us in the economic land and the Federal Reserve. They are still very restrictive, and the growth rate of inflation has fallen on its own. Now, the majority of this index is rent. Housing is 44%. The government is starting to get some real-time rent indexes. In some parts of the country, rent is negative year over year. This growth rate of inflation is artificially inflated right now until that cuts up. But as all of you can see, we no longer have a super tight labor market. We no longer have the inflation rate growing out of control. So I'm hoping toward this end of this year, the Federal Reserve starts to become more dovish, not hawkish. People thought what they said last time was dovish. They're still very restricted based on their own models. The Fed funds rate is 5.25%, 5.5%. The growth rate of inflation is really running at less than 2% on the 3 to 6 month. So I'm hoping they cut a little bit more, but I don't trust this Fed. Now we go to the housing data. Existing home sales. I like to draw black lines on my charts just to show the key points. 2022 had the biggest and fastest home sale crash ever recorded in history. If you look at the peak of 2005 during the housing bubble, it took 3 years to get back to the lows in 2008. Here, we did it in 12 months, right? Different circumstance here. Home prices escalated out of control. Mortgage rates escalated out of control. The market froze. So it's not because demand isn't there, it's just housing affordability got to levels. For example, for my work in years 2020 to 2024, I said everything in housing would be good as long as national home prices don't grow above 23% in 5 years. I never had to worry about escalating home prices in the last decade, but here, the inventory charts will explain this. We went 30% in 2 years once mortgage rates rose. Look at how fast that decline is. It's not because credit wasn't falling, this is affordability. We're missing about 4.2 to 4.7 million home buyers right now. With our demographics right now, we think of demographics, first-time home buyers, move-up buyers, move-down buyers, cash buyers, investors, right? You put them all together, we're trending usually between 4.7 to 5.3 million on average each year. So every year that goes by, that demand keeps on building up. So my concern is when rates do fall aggressively, we might have another unhealthy housing market because the next few charts, when we have the inventory charts up, we'll explain why. But another key data line is this. This is mortgage purchase application data. Notice the 2002 to 2005 market. That was a massive credit sales boom. We had none of that action at all for many years. In fact, if you take the COVID-19 data that was artificially inflated, we never really even got past 2002 levels. So housing changed after the qualified mortgage laws went into place, which means everyone's legit. Most sellers are buyers, 75 to 82% of people that sell their homes buy. They need to go to a mortgage person, they need to get pre-qualified, so wherever rates are, they're comfortable with it, they list their homes. So here, we had another collapse. Now, the last few weeks, this is updated weekly, we've had about 7 to 8 weeks of positive purchase application data growth, but let's be honest here, look at that. Does anybody know what the top songs in 1995 were? Because that's where we're at. So the Federal Reserve last year was saying, oh, housing's recovering, and I'm basically playing no doubt songs, doing clueless move lines. I said, yeah, look at it, 1995, 1996. So the bar is so low, we can all trip over it. So context is key. Whatever sales we get growth here, it's working from the lowest levels ever recorded in history. I would make the argument this is the lowest levels of home sales ever when you take 157 million people working and over 335 million people in the country. That is historically low demand. So there's a lot of upside, but it needs mortgage rates to fall. Now, there was one sector of the economy last year that actually grew sales. That was new home sales. Why did new home sales grow last year? Rate buy down. The builders figured this out. They said, oh, we have all these people wanting to buy homes. We can offer lower rates. They live in a sub 6% mortgage world. They grew their sales double digits. But even they had problems when mortgage rates got to 8%. Small builders cannot compete with big builders. They can't offer the big rate downs, so it hurts their profit margins too much. But the builders grew their sales because they're looking, hey, I got a brand new house. Everyone, come here. We'll give you sub 6% mortgage rates. Compared to the existing home sales market, the new home sales market isn't very big. So when we think about what happened with them, monthly supply for existing homes never got to 4 months. Monthly supply for new homes got over 10. So the builders had to make some deals. So if you're trying to get your seller to cut prices to move product, builders had to do this. Now the next question I'm going to ask is something that not a lot of people know. How many new homes do you think is available for sale today? Does anybody guess? 78,000. In a country of 335 million, 157 million people working, we only have 78,000 new homes for sale. Why? The builders know what they're doing. They're not going to flood the market. Are you kidding me? That's going to ruin their profit margins. Even during the housing bubble crash years, we never had 200,000 new homes available for sale. The builders take a contract, they start their construction, they build their homes, and then once it's ready, the original person in the contract has to qualify. So if rates go up on them, boy, they start to build their products. So they manage their supply. So when people say there's millions of homes under construction, there's millions of homes that are going to hit the market and home prices are going to crash, 78,000. This is why I always say reading is a good thing, right? I've realized not a lot of people read a new home sales report because the builders don't operate that way. So even today, this is the latest new home sales report. We're going to get a new one coming out this week. All we have is 78,000 new homes available for sale. So the builders have cornered this market and they're pushing rates down. It's an advantage for them. Now these next few charts are going to be the key charts for everyone. We're going to go inventory. We're going to go the NAR data first. Then we're going to go with the Altos data that we have. And then we're going to bring the Salt Lake City charts out tied to the Altos. This is the NAR's active listings going back to 1982. I was 7 then. Do you see that long black line drawn down? I call this color book economics. Every single year for the last 12 years, people tell me inventory is going to skyrocket, home prices are going to crash, it's a bubble, the Fed induced this again. We had the biggest home sale crash ever recorded in history, and inventory today, NAR data is 1 million. Can anybody guess how many single-family homes we had available for sale in March of 2022? There's only 240,000 homes available for sale, single family in the country of 335 million and 157 million. That was it. So this data line changed when qualified mortgage came in. 2010, qualified mortgages in, everybody's good, right? What happened in the year 2000, sales were booming, inventory was booming, different credit market. That's never coming back again. Housing market credit busted, there we go. Inventory skyrocket. 4 million active listings in the year 2000, 1 million today. So anybody who tells you it's housing 2008, there you go. Show them that chart. Not even close. We draw the lines for everyone. Every single month we update it. That report just came out just a few days ago. Now we go to Altos Research, which HousingWire acquired toward the end of 2022. We have data lines that are tied to single-family listings that come out at the end of the week. So we have the fastest data line out there. What we want to show is the raw product available for sale that isn't in contract. The NAR data takes single-family, condos, pending home sales put together. As of right now, we have 506,000 single-family homes. As you can see, the COVID-19 inventory broke. Of course, we had a lot of people not listing their homes during COVID. But even when that changed, inventory, the biggest home sale crash ever recorded in history in 2022, that slope was very fast, and then home sales stopped crashing. So we go back to this chart. See that 4 million? A lot of my work over the last 10 years is that it's really rare in America to get existing home sales trending below 4 million. We did it for a few months in 2008. We did it for a few months here. But when home sales stop crashing, everything changes. How did home prices get back to all-time highs in 2023 when we were promised 15, 20% home price crash? Has anybody noticed they always say 10, 15, 20? Every forecast for prices, 10, 15, 20. They just make it up, trust me. There's no model there. They're just throwing it up in the air and hoping it sticks. The inventory slope, much different in 2023, right? So we're nowhere near where we had in 2019 pre-COVID. So this actually shows you why home prices got back to all-time highs within 6 months. Different kind of slope. Then we have this data line. This is new listings. These are the homes that come onto the market that do not get an offer right away. New listings data is trending at the lowest levels ever recorded in history the last 3 years. Roughly between 30 to 90,000. It's very seasonal. Do you want to take a stab at what this data line looked like in 2008 to 2011? 250,000 to 400,000 new homes were coming per week. We have barely broken over 90,000 the last 3 years. So again, if people say housing's crashing, reading is a good thing. That's why you got these charts out there. New listings data right now, 44,000 this last week. These are homes that are not in contract. As you can see, we're still working with record lows. We all understand why 2020 was low. We want to throw that out of there. But the last 3 years, not a lot of people selling and buying, right? Even when mortgage rates were at 3%, even when mortgage rates were at 7%, even when mortgage rates got to 6%, new listings data has been trending at these low levels. I do believe we will get growth in this data line this year. Again, people have to start living their lives. You can't sit in the house forever if you need to move. So we should get a little bit of growth, but let's be realistic here. We are so far from the 2008 and 2011 data lines. Now, how many people here knew that 1/3 of all homes get price cuts year-round? Raise a hand of everybody that knew that. We got one. I tour around the country, and I realized that this data line needed to get out there. A lot of my people that I argue with that hate the Federal Reserve, they take Redfin snapshots, Zillow snapshots, they show these price cuts, and they go, oh, look at home prices are crashing. I was like, did you want to say what the percentage is out there? No. So 1/3 of homes get a price cut. Notice again, 2022, the inventory slope, fast. Biggest home sale crash ever recorded in history, so the price cuts grew. Home prices actually declined second half of 2022, even with active inventory near all-time lows, even with monthly supply below 6 months, something that people did not think could happen. Right there, there's your slope. And as of right now, in 2024, spring 2024 price cut data looks like it's going to go below 2023 levels. So the market has stabilized. Just got to remember, 2022, I would always say, is the craziest year in housing ever. Crazier than 2008, crazier than COVID. We started off the year with very low inventory, high prices. Then we had the biggest mortgage rate increase ever. Housing demand crashed, price cut percentage grew, and then housing stopped crashing. Everything changed. So it shouldn't be shocking to anyone that the price cut data is going to go below 2023 levels, right? There's going to be a few charts coming up that are going to be tied to Salt Lake City, so you guys get to see how you look compared to the nation. Now, new listings data for Salt Lake City Looks pretty much like the national data. Nothing out of the norm. Now, of course, prices are here, elevated more than normal. If you want to blame Californians for that, I'll take some of that blame. But new listings data is not abnormal here. So we're getting a little bit of growth this year, which I think is a positive. You want new listings data to grow. Most sellers are buyers. We don't have any stressed sellers yet. If we had stressed sellers, this data line will explode higher, like we saw in 2008 to 2011. So new listings data in Salt Lake City, and what we do at Altos Research is that we have over 60 data lines for every zip code in America. Pending listings, homes that go on contract, what the prices are going for, single family, condos, everything, and we can cater it to any kind of zip codes in specifics. This is why a lot of Wall Street firms and people come to us for the inventory data. It's faster than anyone else. We don't wait for the existing home sales report. Now, inventory in Salt Lake looks pretty much kind of like the national data. The slope of that curve in 2022, when home sales were crashing, yeah. Everyone at the end of 2022 was like, housing's about to crash in prices. And guess what? Home sales stopped crashing. Even Salt Lake City, as expensive as it is, looks pretty much like the national market. Nothing abnormal here. Price cut percentages, very seasonal, right? Price cuts always happen early part of the year and then increase toward the end of the year. Price cut data here, Salt Lake City, looks like it's going to break below 2023 levels. So the Salt Lake City data actually looks very familiar to the national data. There are some places in the United States, Florida is one of them, Texas is one of them. There are places that have a lot of increases in property taxes and insurance. They have a little bit more inventory increases. But here, I would say Salt Lake City looks pretty common to the other national data lines we see. Now, these are my money charts. How do you explain to people it's not 2008? Everywhere I go, this is the #1 chart I show. This is the New York Fed foreclosures and bankruptcy data. Notice when that black line started back during the housing crash. Foreclosures and bankruptcies were rising in 2005, 2006, 2007, and 2008. And after all of that, then the job loss recession happened. Do we see any of that action in the last 13 years? There was some famous podcaster guy last year that said foreclosures are up 700%. If you see that, there's your 700%. Too small, can't get the job done. You have to be careful of people on the internet. You have to be careful of stock traders. You have to be careful of YouTubers, TikTokers. These are not data analysts. This data has been here for everyone to read. Reading is a good thing. And even today, foreclosures are historically low. Why? Qualified mortgage came in 2010. The 2005 bankruptcy reforms laws. Look at all those bankruptcies that were happening in the early part of the century. Why was that going on? Game was over. 2005 bankruptcy reform laws, everyone filed for bankruptcies before they could, that law enacted, can't do it anymore, easy. So the data cleared up. The credit market cleared up. So here we are, total balance of delinquencies, 30, 60, 90, 120-day lates, NOD fines, everything near all-time lows. So back then, we saw stress in the credit markets while the economy was expanding. Here, we're at near record lows. So when we think about foreclosures, once you start to get an NOD filing, you're probably looking at 9 to 18 months before that house comes onto the market. Each state is different with judicial laws. So the credit profiles look great, near all-time lows. Does anybody know how many homes in America, or what the percentage is of homes that don't have a mortgage? 42% of homes in America don't have a mortgage. That's a lot of equity. Pretty hard to go bankrupt or go foreclosure when you have no mortgage on. So this is one of the reasons why this data line looks good. We fixed the credit markets. We're going to be fine. Now, when a job loss recession happens, when that jobless claims breaks over 323,000 and people we'll start to see their homes being stressed. Yes, this data line will increase. It's always increased when we have a job loss recession. We're not there yet. We do see an uptick in the 30 and 60 days. Now, I would argue that something I've talked over some time, we're going to get back to the pre-COVID-19 levels, and then we should be fine. Until jobless claims break, this data line is going to look pretty solid. And just kind of remember, 30 to 60-day lates, historically, 1% is normal. So on the credit side, we're okay on that. And this is one of the most beautiful charts I love. Every time I show this, I have to sit here and look at it. This is why the world hates us. The world hates our guts. Not only do we have 42% of homes that don't have a mortgage, not only is the nested equity, homeowners' cash flows have never looked better in U.S. history. And this data line has been here for 13 years. People say, oh, Americans are stressed, they're struggling, they can't. Oh, no, not homeowners. So you see that explosion in 760 FICO scores. Some people will tell you it's FICO inflation. No, the data's look the same for 13 years. It's just that we originated a lot of refinances and purchases during COVID, so the volumes grew. Again, the world hates us because our homeowners look great. Why? We have Freddie, Fannie, FHA, VA. We have the best plumbing system in America. We have qualified mortgage, and this data line has been here. We had the longest economic and job expansion ever recorded in history until COVID came, and that was a very brief recession because homeowners are in a much better place. You're not getting this market ever again. It's done. So anybody that tells you 2008, you show them these charts. There's always an Uncle Dave in every Thanksgiving. Even Uncle Dave has to see those black lines drawn and figure it out. Now, also, mortgage debt service payments as a percentage of disposable incomes are also near all-time lows. This is another reason why everyone hates us. Why? We have the 30-year mortgage. What's the best hedge against inflation in America? 30-year mortgage. That means the best hedge on planet Earth is a 30-year mortgage. Why? You buy a house, you have a fixed debt payment. We haven't dealt with inflation in a very long time, but traditionally wages have to rise faster during an inflationary period. Your house cost, in terms of your debt payment, gets less. Your wages go up, your debt cost stays the same. So you want to know why people just don't sell their homes and be homeless? Everyone is doing good. Cash flows are excellent. So this is not the credit markets of 2005 to 2008. No more exotic loan debt structures. Pretty vanilla, 30-year fixed payment. And then the ultimate everyone hates us chart. A lot of countries do not have a 30-year mortgage. In Canada today, somebody's getting a loan modification for not 40-year, not a 50-year mortgage, but a 90-year mortgage. Why? Because the Canadians made their entire mortgage market tied to short-term rates. Their home prices escalated out of control, and now they have to pay the piper. So their loan modifications have reduced now to 90-year mortgages. Why? Because their payments are going to double on them. All those countries out there hate us. Why? Because they can't replicate Freddie and Fannie. So we have not only the best credit profile on planet Earth, not only the best FICO scores on planet Earth, not only the best nested equity on planet Earth, majority of homeowners are always working. Right? Whenever we have a job loss recession, typically those that did not finish high school, service sector workers get hit the most. So whenever the job loss recession does occur, we always have to put it in context that it's not the 2008 market because we do not have short-term fixed debt anymore in our system. Other countries do. So the other countries are getting hit harder. We were the country that prices rebounded first, faster. Why? 30-year fixed mortgage, they don't. And to be fair, all those countries up there, their home prices escalated much faster than the US did the last 10 years. So they're working from a different bar as well. Now, another key difference, this is a very important chart to talk about the marketplace. This is the Mortgage Credit Availability Index. As you can see in 2004 to 2005, things got crazy and chaotic. You know, the market was booming in sales. You had to create more exotic loan debt structures. I knew it was really crazy when we had actually a 100% negative amortization loan offered. That's what it was. For some of you, I don't know if some of you remember that. I live in Irvine, California. That was ground zero of subprime. But somebody literally came out with a 100% negative amortization loan, which was the economic weapon of mass destruction to me. But that was the crazy market. And then after 2010, everything's pretty vanilla. Boring is a good thing, right? All those countries wish they had boring. We have it. So when COVID happened and this availability index fell, people said, oh, housing's doomed. There's nothing. Credit's going to go down. Not really. This conversation will come up more and more when the job loss recession eventually happens. But just remember, the credit availability index never budged higher during the time where we did the most loans, right? Because we're pretty vanilla here. It's a 30-year fixed product. Bank statement loans aren't like exotic loans or anything like that. Not even the non-QM loans that are being offered don't resemble the loans that were being provided from 2002 to 2005. And then another why the world hates us. They say America is broke. We are a broke country with 171 trillion assets. We will smoke any country in the world. Our home values are bigger than the total GDP of China. Why? Homeowners. Fixed debt cost, rising wages. Mortgage debt is the biggest consumer debt out there. So when they bring out big, scary numbers, there's $20 trillion of debt, they never talk about the assets on top of it. They never talk about the payment levels for those that have the most debt. Traditionally speaking, homeowners have the most consumer debt. They also have the best financial profiles, not only in America, but on planet Earth. So we are not a broke country. Maybe Cleopatra in her prime was wealthier than America, but we have a lot of things here. Homeowners have access to things that other countries lack, right? 30-year fixed mortgage, staying in your home, the nested equity positions, the cash flows. Let's go back. I just gotta love that chart. Look at that. I have counterparts in other parts of the country, and I send them this in the middle of the night and go, stop hating. Stop hating. Don't do it. Don't bring out your credit scores. Can't compete with us in America. So there we go. So be careful of when people say Americans are broke. Single household renters, yes. Young single household renters, yes. That's a problem. Rent inflation took off. How many of you heard rents are going up crazy from your friends, family, or anyone? Yeah, you don't have that renting. You don't have that fixed payment. So rent inflation took off. And again, the history of global pandemics, very inflationary, especially in rent. Rent inflation takes off, and then the disinflation happens. But here, homeowners, every single one of you people put your clients into the best financial positions probably ever recorded in history. And we all have the data to show it. There it is again. There it is again. There it is again. All of you did this. Now the downside to everything, home prices escalated out of control. So we go back to that talking point a few minutes ago. How many homes were available in March of 2022? 240,000 single-family homes. For a country of 157 million people, too many people chasing too few homes. We finally all paid the price. I mean, you look at the housing bubble years, and it never looked like anything that we saw there. Because why? Let's go back to this. All these years, inventory was slowly going down. How did this happen? Well, what home buyer doesn't provide you a house? First-time home buyer. The millennials, the biggest generation in our history, started buying homes in 2013. Inventory started to go down in 2014. So most sellers are buyers. Then the first-time home buyer comes in, inventory could slowly move lower. biggest concern for me, years 2020 to 2024, what if inventory breaks to all-time lows when we have this 5-year period where we're going to have a lot of home buyers? That could be problematic. This is what happened, right? We finally paid the price of not having enough product. It isn't because home sales were booming, you know. It was because we have really good financial homeowners. There's no credit stress in the data. Everyone is doing great. Oh, look at that. And then lack of product. And this is a hard problem to solve. So what I wanted to show you today is try to explain why are home prices still rising? Why does America just kick everyone's butt? You know, because our financials are much better. And the problem is that sellers are buyers. People think it's a mortgage rate lockdown. I have this debate with my HousingWire podcast, Sarah Wheeler and I. It's not a mortgage rate lockdown. In a sense, mortgage rates got to 3% in 2021, and guess what happened? New listings data was still near record lows. So this is a key data line for everyone to remember. From 1985 to 2007, people lived in their homes 5 to 7 years. From 2008 to 2024, that's moved 11 to 13 years. In parts of the US, 15 to 18 years. I've lived in my home for 20 years. We've been building bigger and bigger homes for decades. Family sizes have been getting smaller and smaller. So a lot of people are kind of one and done. If you have an older house, smaller house, you need to move up, yeah, you move. But millennials were the biggest home buyers for years up until mortgage rates got above 6%. Then the baby boomers. Actually, technically, Gen X was the biggest percentage, but nobody cares about us at all. So nobody likes to bring that up. I bring it up, nobody knows, because it doesn't matter. We're the middle kid. So this hopefully explains to you that we have demand there, affordability. We need the 10-year yield to go down. Demand can pick up. Whenever mortgage rates fall, demand picks up. We need the Fed to start realizing they overhiked, right? Why hasn't the recession happened in America? Every single recession in the past 4 decades has always had residential construction workers go down. So Wall Street creates these crazy models, except residential construction workers have not fallen. The baby boomers are leaving. That age group is very high. They need those homes to be built. We have more homes that have never started construction than ever in America. But do you know how much that is? 106,000. That's it. The builders aren't going to save you. The credit channels are great for America, but for home buying, you just need more sellers to be buyers again. And that's only going to happen when mortgage rates fall. And that hopefully explains. You see that home price crash, that little small dot lower in 2022? That was it. All this hype, all this talking, all these housing bubble crashes, that little, if you can't see it, don't worry, it's that small. One of the last few charts here. The red line is the equivalence of rent. As you can see, home prices escalated. There's a big gap between home ownership and renting. Why do people buy homes? That's what people do traditionally. At a certain age, they tend to buy homes. Single household renters, 1/3 of the nation are going to be lifelong renters, unless they're part of a dual household income. That's been in the data for years. Home ownership percentage is less than 4% from the all-time highs. And that all-time highs was very inflated too. So it's not a renting nation. But as we can see, the issue is we escalated out of control. Too many people chasing too few homes. But here we saw rents and home prices grow a little bit faster than normal. So the housing inflation was the story. I have a weekly tracker. My weekly tracker is my economic model for housing. It looks forward, not backward, okay? This is the QR code for HousingWire. We talk about active inventory, new listings data, price cut percentages. It's really funny. People tell me, home prices are crashing as a price cut percentage is falling. Have you ever read the data? No, of course not. Reading, not a thing for people. That tracker, it also talks about purchase application data. It also talks about the 10-year yield, talks about mortgage rates, talks about economic data. The goal for me is to teach everyone how to look forward and what you should all anticipate. Every single weekend it comes out, and it's designed to look out 30 to 90 days. Because in this kind of market, things move like this. So you want to be up to date, because now in this age, 600-700 years ago, you dispatch horses, go to another country, they get information, it takes 6 months to come back, they tell you Spanish Armada is about to invade you. Now, 6 seconds on the internet, you can get data. That's the advantage people have here. Now, this is the Altos QR code for them. Altos has over 60 data lines on all inventory demand data for every zip code in the world, right? Mostly housing in America. This is designed for agents that want to get an edge on the most current and up-to-date data. So one quick story, Mike Simonson, who's the president of Altos Research, 2006, he created his company. In 2007, he went to Wall Street. Talked to Lehman Brothers, said, I have this data line, it looks like housing's breaking. Lehman Brothers said, oh, get away. I have 85 analysts. Mike Simonson went down 50 feet, talked to Goldman Sachs. Goldman Sachs saw the data line, shorted the housing market, made $10 billion. Lehman Brothers went out of business. Goldman Sachs still hasn't sent a thank you letter to Mike Simonson. So his data line is very nerdy, very geeky, but it's designed to give you the freshest, fastest information, what's current, because if you wait for sales data, that's lagging. Now, does anybody have any questions?
I'm just, so all the residential information from even my own studies, I go, yeah, sure, absolutely, but what do you think about the maturing of the bank term funding program in March, at the end of March, which of course they've got a lag of like a year in order to do anything about that. And then all the commercial inventory.
The commercial industry is in a really, really big pickle, because that is a structural change. That is going to force some banks to go under. It doesn't tie to the residential marketplace, but for the commercial industry, I was just speaking at the California Association of Realtors event, and we had Stanford and Berkeley and everybody, and it costs like $100,000 to make a door in California. Nobody builds anything. And they were trying to find solutions. I said, there's a lot of vacant buildings. Why won't they put housings in them? They can't. The coding doesn't work. It's too expensive. So I said, blow it up. Blow it up and start from scratch. Because right now, there's only 217 vacant buildings that are in the process of maybe becoming housing units. So the commercial problem is going to be dealt with a lot of bank mergers and a lot of companies going into bankruptcy. It's going to tighten lending in commercial real estate for sure, and it's a slow-moving death. Anybody remember the Austin Powers movie where the guy's in the ice skate rink and Austin Powers is coming to him with a slow ice rink and he's screaming and it takes him forever to get killed, but he's screaming? That's the commercial market. It is a very, very slow-moving market. In terms of bank funding, for residential real estate, Freddie, Fannie, if they were publicly traded companies, I would have a much different opinion about the housing market, because as you can see, when stocks start to fall, they'll retrace back. Since they were in conservatorship, housing is protected to a degree. The commercial industry, on the other side, there's going to be a lot of pain coming in. And we're going to see tightening of lending in local businesses. Now, they're stalling. They're purposely stalling it out. And the lenders in the back minds are trying to work something out in the future. So I don't know what the final resolution is, but it can't be good for some of those banks. I do believe the Fed's going to get them to start merging with their companies. Yeah.
That's what it appears. There's been a lot of talk of that, and I don't know of any way that they have planned to save that. It sounds like you don't either.
The Federal Reserve, if they wanted to, they can buy up a lot of the commercial debt and merge them. That's what they did during COVID. COVID, the Fed bought everything. You ever notice we just recovered like in 6 weeks? All the credit stress that we saw, the Federal Reserve came in. The Federal Reserve, by choice, is not doing anything there. So they emerged in Silicon Valley Bank. You guys remember that? Huge banking crisis, 24 hours, done. The Fed has the tools to be the lender of last resort if they wanted to. It also makes them very cocky. That's what I think the Fed is. The Fed feels like if any major crisis comes in, they can do what they did in COVID and everything will be fine. Any banking crisis, they could go in there, merge those companies, buy the distressed debt, take the losses on the books. But commercial is just very slow. It hasn't hit us yet. So when credit gets tighter, it does impact the economy.
Can you address the elderly market? We have an aging society. We have a lot of wealth tied up in these homes. The talk of transitioning out in the next 10 years, massive amounts of wealth. How would that impact your numbers?
This is actually one of my favorite topics, the silver tsunami. The silver tsunami was created in 2008. Why? Because the first baby boomer hit 62 in 2008. So from 2015 to 2025, we were going to have 30 to 60 million active inventory hit the markets. It makes sense, right? The baby boomer's 62. By the time they're 69, they're all going to downsize. Let's see how that turned out. Oh, my God. So, and I've been dealing with this for 10 years. Even this year, Meredith Whitney, who is a Wall Street person who's never talked about housing in her life, said the silver tsunami is coming this year. That new listings data is almost at all-time lows. You be careful of Wall Street, okay? One of the things I do is I challenge all Wall Street people to live camera debates. After a few of them tried, nobody wants any of this anymore. So be careful, but I always say, no country has a Dorian Gray labor market. We're all going to die. Nature wins. By the end of this decade, we're going to get a group of people now getting into their 80s. They will pass off. They're going to give their homes to their children. Children are going to have a lot of wealth. What they do with the house, we're going to have to wait and speculate on that. But it's coming. It's just not as fast as everybody thought. Because we're sitting here. We're supposed to have 32 million active listings in America today. We have 1 million.
I guess in relation to that, there's this huge wave of millennials that are reaching peak homebuyer age. How do you see this thing?
So the millennials, years 2020 to 2025 was actually, or 2024 was the biggest home buying millennial group ever. So we're kind of in, and guess what? When mortgage rates rose, guess what happened? Millennials weren't the biggest buyers anymore. First-time home buyers finance 90% plus of their mortgages. When you get past the age of 58, more than half of your purchases are cash. So the baby boomers win again. But in this case, Gen Z is massive. Gen Z is bigger than Gen X. So millennials actually, if you look at their home ownership rates, more than 50% of them own homes, but again, 1/3 of society are going to be lifelong renters. We have a lot of young people in cities still, and they're renting. And as long as they live in the cities, they're going to keep on renting, right? Unless you get part of a dual household income. Gen Z will provide some. Actually, Gen Z is buying homes earlier than the millennials. You got to remember, the millennials came in right after 2008, so the whole credit markets were messed up. I'm not a big housing sales boom person, but I think you had decent replacement buyers. We have to look at this. America has one advantage over a lot of countries. Even though population growth is slowing in America, it's still growing. China, done. Japan, done. Europe, done. Japan's 40% of their population will be dead by the end of the century, right? We have the benefits of still having a growing population. It's very slow. Parts of the US do not have a lot of young people moving there. But as a society, if you look at other countries, they're going to hit the demographic pain first before America. Germany has this right now. Germany's home prices are down like 15-16%. They're renting like crazy over there, but they've got a lot of people ages of 60 and up. They don't have the young home buyers that we do here in America. So millennials and Gen Z, both of them combined are bigger than the total population of Japan. That's our American muscle right there. Next question.
So to parlay that and everything else, the fact that with medicine and everything else, everyone's living longer. So does that offset the, because they have to live somewhere?
3/4 of the country is living longer. In the South, that's not the case. They're dying at a younger rate. Heart disease is the biggest killer every single year. So even in those areas, you don't see an inventory glut. I just think that age 80, you start to get the big wave of death. I hate to say it that way, but it's true. Those homes will be passed on. I mean, people have to realize when you die, you go into probate. It might take a year or two before the house even gets settled out. So it's not as fast as inventory. But again, we have the new listings data. If anything happens as a silver tsunami, we'll get it first. So I do think eventually nature wins. And the Detroit Lions aren't going to win. Go ahead.
Yes, they are.
So then the silver tsunami, we're going to wait and see. What about getting new inventory out there for new construction? I mean, you said people aren't motivated. Is there any hope that we're going to, that's going to get better?
No.
Or what?
No. You know, it's interesting. For the last few years, people said, there's more homes under construction than ever. Literally, we had a housing credit crash, and the thing never even got to 200,000 homes, right? The builders are here to make money. They are not the March of Dimes. You think they're going to flood the market, and then all of a sudden their prices are going to go down? No, right? Smaller builders are at a disadvantage now against bigger builders. So they manage their supply, and that's one thing. Now, I mean, in the last decade, I actually regret not talking about it as much. But when you look at the new home sales data, so much of this monthly supply, it's like Wall Street would tell you, oh my God, it's the housing bubble crash. Monthly supply for new homes. It's like, you guys never read a new home sales report. That's not a lot of homes, right? So the monthly supply looks like the housing bubble years, but again, 78,000 homes. The builders manage their supply because they're here to make money. You are never going to get them to oversupply a market in a fast way.
And then a follow-up question. You addressed the millennials buying that and taking up a lot of inventory. What about investors? Is that a major factor, or is that just news that is a talking point as well?
Another favorite topic of mine. Wall Street buying all the homes. We went peak crazy about a few weeks ago when some person on the internet did a video and said 44% of all the homes in 2023 were bought by Wall Street. Do you want to know what the exact number was for that quarter? 0.4%. How do you go from 0.4% to 44%? Okay? Yes. I am telling you, I've done this economic writings for the last 14 years. The only reason I'm even here talking today is because everyone is crazy out there on the internet. YouTube is crazy, stock traders are crazy, TikToks are crazy, Instagram is crazy. So I'm here to try to give everyone the real data, but Wall Street, they went from 0.4% to about 2.1% of the market. That was the biggest percentage. Mom and pop investors, majority of all investors are mom and pops. You can't really make a class warfare agreement when your neighbor Dan is buying a house as an investor. You can't really make them the villain. So we use Wall Street. Everyone says it. They're buying their homes. Nope. Mom and pop investors, those who own 1 to 9 properties. I always joke with the person, I'm the worst real estate investor ever. I have 1 investment property. I never raised rent for 10 years. I never collected rent during COVID. But I'm the majority of the percentage of the data, not Wall Street. Wall Street's very small. In fact, people don't even know there's Blackstone and there's BlackRock. BlackRock has never purchased a house in their life. So they get mixed up with Blackstone. And people keep on saying BlackRock buys all the house, and they have to make a marketing in the New York Times. We are not Blackstone. We have never bought a house ever in our portfolio. So mom and pop investors are definitely part of the game. And then remember, rent inflation going down is a good thing, right? Majority of our inflation data is rent. So they're providing a service in terms of renting because we don't want to pit renters versus home buyers. Airbnb, that's another story. That's another crazy story that happened last year. Do you know how many homes how many total units in America we have? 146 million. Airbnb is less than 1% of that. So this huge housing crash from Airbnb last year, God, I don't know. You guys see that? That's the Airbnb crash of inventory. So be careful. Wall Street's not the biggest home buyers in terms of investors. Mom and pop investors are. They're providing a service in terms of getting rental supply in there. And the credit channels are much different. We never had a home sales boom like we saw in 2002 to 2005. Next question. Anybody else? Oh, go.
So you talk about Gen Z, Gen X, and the silver tsunami. What's your take on the Hispanic home buyer? I've read that that's the biggest market.
It is a huge part of the market because it's a huge part of the labor force growth. Like the Hispanic labor force growth, if we didn't have that, we are Japan. It's the majority of the growth in our labor force, and especially in high population areas. So you get to a certain age, dual household incomes, that gives you that buyer demand. Absolutely. It is critical, especially going in the future. They are the youngest generation in terms of the median age. Still, on a relative race basis, Caucasians are the most, but as a form of a younger buyer, they're the youngest, and that's why they've been growing for the past few years. Next question.
So the internet told me, Instagram, YouTube, that the Fed's going to cut rates 6 times this year.
No. I wish. I wish. If the Fed is cutting 6 times, that means the labor market is getting weaker. So that's why I say that jobless claims, like everything for me is, like who told you guys that inflation was going to bring down mortgage rates last year?
You really want us to tell you?
Yeah, tell.
I heard it.
Barry did. Okay. So jobless claims started to take a tick lower as the first wave of layoffs that we had, and guess what? 10-year yield rose with that. So I understand inflation falling down is so key. We are not talking about rate cuts if the growth rate of inflation hasn't fallen. But if you look at it, we're still above where we were in the previous decade. Also, global bond yields are higher. Nobody talks about that. That's really important. Where bond yields are across the world, the bond market is this massive market. They all kind of work together. So this is one of the reasons why I had to bring out Gandalf and say, we're not passing, guys. I would love to, but I just don't see the labor market breaking. 6 rate cuts, they should cut 3 at the end of this month and 3 right after. But for those that listen to the podcast, I call the Fed. They're old and slow. The institution is designed to be slow. They're not designed to be fast. COVID, yes, they were fast. Unless it's an emergency crisis, they move very, very slow. So I'm in the 3 rate cut camp, and which means I'm going to be bashing the Fed.
3 this year
3 this year.
and 3 next year.
Next year is going to be interesting. Next year you can, because here's why the Fed is now talking about rate cuts. The Fed told us in 2022 they wanted the Fed funds rate to match core PCE, 3, 6, 12 months. Well, guess what? Core PCE is about to be under 2%. We are very, very restrictive on Fed policy on any historical measure they've used. So they should be cutting 6 this year, 6 next year. But the labor market, if jobless claims rise, the bond market will force the Fed to cut. Okay, and that means we get to even bash the Fed even more. So more aggressive rate cuts usually means jobless claims data is getting worse.
Do you foresee that happening? Do you see us hitting that 3?
If it's all depends on residential workers. We don't usually have a recession in America unless construction workers are the first wave of job losses. And the builders, we're not growing them anymore. The apartment boom is over, but we still have a backlog. We're keeping it at bay. If rates do not go lower, oh boy, that residential construction data could start to fall. So that's why we track those data lines religiously every month. I thought that was one of the things that a lot of recession people missed. So we're going to keep an eye on that, but we focus things weekly. Try not to look too ahead every week, but 30 to 90 days, that's our model. Next question.
There's a lot of talk about how presidential elections impact rates, but none of it seems to be supported by much data. Do you have any?
The best example I could give you is when President Trump won in 2016, the bond market shot up because they anticipated growth to come in. A lot of people say the deficit spending was going to come in. No, people anticipated growth. Economic growth, bond yields go up. Economic growth slowing down, data getting weaker, bond yields go down. That's that slow dance chart we always talk about. here, inflation and growth was picking up in the late 70s. Now, inflation, the growth rate has been falling for decades. Global pandemic came, 10-year yield went up, 30-year mortgage went up. We're starting to get that slowdown in inflation. If economic growth slows down, mortgage rates will go down. Doesn't matter who's going to win the president. But also remember, in our country, congressional power runs the show. It's really who owns the Senate. So we start to get more interested in that when Senate, President, House, what bills can be passed. But the best example I could give you was when Trump won, 10-year yield went up, mortgage rates went up, anticipating better growth, and it was correct too. Any more questions? Okay.
Explain quantitative tightening and its effect on rates.
Now, quantitative tightening, the Federal Reserve is winding down their balance sheets. That means they're selling their assets. This also is problematic if you want the 10-year yield to go down. So what the Fed has done recently is they said, we're going to slow this process down. If the Fed wanted to, they say two things: 10-year yields going lower, mortgage rates will be down 1% within 24 hours. They choose not to. They're doing this slowly. So a lot of people said when QE ended in 2014, the 10-year yield and mortgage rates were going to shot up. Guess what? Mortgage rates went down. When they said QE was going to come back, inflation overrided everything. So I would just focus on, if they slow that down, that's a better process to keep rates in kind of in line. What happened last year is they got spooked when the 10-year yield went to 5%. This is the reason they're talking about slowing down the QE. They want an orderly 10-year yield market. They're still too hawkish for my taste, but they're slowing down the process, or they're talking about that for that very reason, to keep the market in orderly. There's buyers and sellers. People love our bonds. It's not because we don't have an appetite, but they don't want to be selling too much when we're issuing a lot of debt also. It could create a chaotic market like we did see last year.
Back to kind of Brittany's sentiment, with such a low inventory, if they cut rates, doesn't that just exacerbate the problem because we have high demand and everybody coming in?
This is why I say the housing market, the phrase I coined was savagely unhealthy. What do? Right? How do we fix this problem? Because home sales are now third calendar year of great recession lows in demand, and home prices are still rising. But you can't have a country just sit here with home sales until inventory grows into a meaningful fashion, because once it grows, it goes down. There is no easy answer for that. There hasn't been. We eventually paid the price of not having enough product. It wasn't just home prices, rent inflation took off. But that was a marketplace 3% mortgage. 5 to 6% mortgage rates, you can grow sales. And I'm not too worried about, we had 75% of the market have multiple bids in January and February in 2022. Sub 3% mortgage market rate, different story, 5 to 7%. So I'm not worried about home prices going up 15 to 20%. I know Barbara has commercials about that. That's not going to happen. Mortgage rates are high. Affordability is still an issue. Home prices are high. It's not like home prices are crashing and rates fall down with it. So the affordability will keep it in check. But a sub 3% mortgage market would be extremely problematic for that. So I'm not concerned on that aspect yet, because I think it's going to take a lot of things for rates to get down to 3% again. Any more?
Two questions. One, how likely is it that Fannie and Freddie will start purchasing MBSs to help narrow the margins? And what do you estimate that timeline? And two, what can communities and states do to help create, if anything, affordable and attainable housing?
The second question is very interesting. What is affordable housing? What does it look like? Yes. Do we build anything tied to the median income underneath? Why? Inflation. Builders are building bigger and bigger homes to make profit margins. I actually don't even believe in the concept of affordable housing construction. The incomes people make housing affordable, where the rates are. states have to build things tied to certain income brackets and only allow those income brackets to get the homes. That's, if you wanted a local state, affordable housing has to be on that. Or you just keep on building and building and building until supply overwhelms and you get, you know, an affordability easing on that. But builders don't do that, right? Builders are here to make money. So the states would have to do something locally. It's in discussion about Freddie and Fannie. I know this because I've not talked to my brother from another mother who's a chief economist at Freddie Mac. Doesn't talk to me anymore as soon as this conversation starts to get up. So I think this might be something a few months down the line that gets a whisper, because we're already hearing that they want Freddie and Fannie to start purchasing mortgage-backed securities. That would actually be very beneficial. As soon as that happens, I'm telling you, we could have mortgage rates fall half a percent to 1% in 24 to 48 hours.
And that'll just be off the runoff.
Yes, that'll be. So we don't even need the 10-year yield to do anything. So that is in the works right now. Can it get done? Because the Fed doesn't want to do it. Remember, the Fed can change everything about housing if they wanted to. They choose not to. All they've done is made 3 statements. Last year, 6% mortgage rates was causing them too many problems. Boo-hoo. Go fishing. Then housing demand's recovering. Purchase application data is back to 1995 levels when we were watching the Clueless movie. And then finally they said, it doesn't look like 8% is good for first-time home buyers. That's all they're saying, right? They don't want any of this. So it's going to have to be the government trying to get Freddie and Fannie, and it's a conservatorship. They can do it. They can take those profits, buy mortgage-backed securities. Hopefully they get on that sooner than later.
Is there a model for estates right now that are effectively making, I know you don't like the term affordable housing, but trying to create that first-time home?
Utah, to my understanding, does not have a homeless problem anymore, right? We have a homeless, well, the places where they're building shelter, Austin was one of them. Don't look at California. California is absolutely the pit of hell in terms of building housing. I think the city of Austin built more homes than the state of California did for like 2 years in the last decade. Smaller homes that are done by cities and states affecting a certain income, it's so small, they don't even show up in the data lines. You can't even really model this out. But Minneapolis did do zoning regulations, and they are building there. They're building a lot of duplexes and triplexes. So those areas that are giving apartments or duplexes, those things are working, but that doesn't help us. Why? Because people love single-family homes. This is America. You think families want to live in apartments? No. We all want our big single-family homes. We all want to watch our TV shows to tell us how to design it and fold our laundry and everything. So it's great for renting, not great for home buying. That's a problem. So a lot of the solutions that we've seen, places in Minneapolis or even in some parts of California just takes too long to build. But you do those duplexes, triplexes, you get that rental inflation down. Any more questions?
So interest rates are going up.
Do you see that red line? That's my peak level for 2024. 4.25 10-year yields, 7.25 for mortgage rates. The spreads are so good now, not so good, but they're getting better that I'm not going to get my 7.25 mortgage rates if the 10-year yield gets to 4.25. So we're in the upper end of the range of the high level, but it should be a lot lower. I think throughout the year, especially if the labor data softens up, the 10-year yield will head lower on that. Last year we saw that, but I still have that Gandalf line right there. So expect some Gandalf stuff to come out unless the labor market really breaks.
So what you're saying is it's not just a straight plummet?
No. A straight.
They tell me that on YouTube.
Yeah, a straight plummet. God, YouTube is so like I don't follow a lot of people just because I used to like watch things, talk, and after 3 minutes I go, these people are all crazy. So YouTube, you got my best advice for everyone. Do not listen to anybody unless they have forecasted for 5 to 10 years. If they have not forecasted for 5, 10 years, trash. If they do not provide you an actual live model for housing, more trash. And guess what? Trash sells in this country. There is some crazy kid in Texas He gets 4 or 5 million views. He's been talking about home price crashing since 2019. Doesn't matter if he's right or wrong. Trash sells. That's why YouTube, TikTok, internet, stock traders on CNBC, you got to be careful, right? Only follow people that actually have like a history on this because they care. The other people don't care so much, right? Because it's to their benefit to be doomers, as I call them. In fact, one of my things over the last 12 years, I've documented the housing bubble boys 2.0, 3.0 for 12 years. I said, you guys are going to be so wrong that 12th year is going to happen, you're going to be a broken clock. A broken clock has a better economic game. That was last year. We had a little ceremony about it. So be careful of YouTube. And a plummeting 10-year yield, labor market breaking, stress in the market. We saw that, at the end of 2022, the global crisis. London was going to lose all its pension funds. I don't know if you guys remember that. London was going to lose its pension fund. The Bank of Japan, all hell was breaking out because the dollar got too strong. By the way, the dollar collapsed, people. They're the craziest of them all. Okay, so be careful of that group. So here, when the dollar gets too strong, the world can't handle it. 10-year yield went down, but it stopped. That Gandalf line held because the labor market wasn't breaking.
With the inflation that we've had since, I guess it halfway through 2020, do you think inflation was inevitable, or do you think the inflation that we just had was actually avoidable?
It is historically impossible for inflation not to take off in a global pandemic. I've looked at it for 500 years. It always happens. Why? People are dying. We don't function as a country or a global panic because supply chains don't work. So then the US recovery was unbelievable too. So I've never seen war or global pandemic that is big scale not be inflationary because supply chains don't work. I mean, the Red Sea right now, we got a few pirates shooting missiles, and guess what? Shipping costs have already gone up 30, 40%. So war and global pandemics are always inflationary because supply doesn't work normal, and it takes a while to get things. So this explains the unbelievable inflationary hit, unbelievable inflationary dies. In fact, I talked a lot about how it was in 1918 to 1920. Inflation took off, rents took off, and then the disinflation happened. So if it's a global pandemic, it's always going to be very inflationary until things get back to normal. This is not because the Fed did something. There is no way we could sustain that kind of inflation. The economy would have to be booming. Sales and growth and labor force, we don't have that kind of marketplace. So this actually looks pretty normal to me if you have a global pandemic in this day and age. So whenever you see big war, Russia, when they invaded Ukraine, what happened? Wheat prices took off. Oil prices took off. And then they came down. Not because we changed anything. We are producing more oil now in this country than ever, right? And oil prices are still high, but that spike, all that wheat prices, everything was war. So war and pandemics are inflationary. I can't see how you avoid that ever. Anymore, this is a good crowd. Okay, going once. Going twice, Detroit Lions fan here. Do you have anything?
Who's the best generation?
Best generation. The silent generation. Thank you, everyone. I hope this was very enjoyable.
All right, so what I learned, reading is a good thing. We gotta look at the data and see the whole picture and not just the snippet of the little foreclosures.
Yes, I forgot. I have 2 taglines. Economics done boring. Economics done right should be boring. It's not designed to be this hot, fun, sexy thing. Okay, it's not. It's a terribly boring stuff. And you always want to be the detective, not the troll. And don't watch YouTube.
Amen. All right, so given that, another huge round of applause for Logan, please. As a reminder to everyone, you can listen to Logan on the HousingWire podcast on Mondays and